We wanted to start off by saying thank you to Kennesaw State University for helping host this event, as well as the CFA Society for putting on this research challenge. 30 years ago, that's the last time that a nuclear power plant was newly operational within the United States. That is until Plant Vogtle. Southern Company is setting themselves up for a future of long-term growth, and that's why we are recommending a buy with a 4.5% upside. Our investment thesis is predicated on that historical strength regarding dividends, both in terms of growth and yield, a large capital investment plan that leads to higher returns on equity, and finally, their low volatility compared to peers. My name is Cameron Overton. I'm here with Trace Forrest, AJ Mercer, and Jeffrey Tocco. And now let's hear a little bit more about Southern Company's business model from Jeffrey.
Yeah, of course. Thanks, Cam. Let's just dive in right about Southern Company. Been around for about 80 years now. Operates in the Southeast over about 116,000 miles, providing electricity and gas to customers all throughout the region. They break themselves down kind of into those two major categories: their gas local distribution companies and their public electric utilities, and they further break down their revenue based on their kind of customer demographic and customer type, whether it be wholesale or retail. And they also have an unregulated business that produces about 12,000 megawatts of energy per year, but that doesn't represent a massive portion of their revenue. Going into the industry a little bit further, the industry does kind of format as legal monopolies, as these companies are designed to serve the public good. That encourages some interesting regulation issues, which we'll talk about a little bit more, and also some interesting competition with alternative energy sources. We do see a relative strength in Southern Company based on their region and that territory, with higher population growth in the Southeast and other areas. And as we learned on their most recent earnings call, they are seeing huge construction growth, especially in Georgia, with a lot more data centers being put up, which uses a lot of electricity. Speaking of that electricity, we are seeing huge growth and consistent growth as the society becomes more reliant on technology, and investments have seen steady growth over historical times.
Yeah, so since 2007, Southern Company has seen significant decreases in their greenhouse gas emissions. By doing this, they have decreased their coal unit plants, as well as increasing their renewable energy sources and the addition of the Plant Vogtle units. By 2050, they do have a set goal to be a net zero carbon emission company. For the past 8 years, Southern Company has been ranked the top 50 company for diversity. By doing this, they recently partnered with historical black college universities, as well as partnering with military installment programs and operating with diverse suppliers. For the management team at Southern Company, the CEO is heavily incentivized for their ESG efforts. He has a pay package directly linked to ESG. On the chart on your right, you can see that Southern Company is ranked 13th out of 48 different United States utility companies, and further demonstrating their stronghold on ESG. And now AJ will be talking about investment risk.
Thanks, Trace. We'd also like to cover some of the risks relevant to Southern Company's business model and the steps that the company takes to minimize the impact of these risks, highlighted by exposure to volatility in commodities and energy prices. Price volatility and elevation can harm the company's margins and therefore reduce their earnings. However, Southern Company uses derivative contracts to hedge their exposure to this risk, and elevated energy prices are expected to normalize in the coming years. Additionally, their exposure to weather and climate risk, fluctuations in weather can impact the company's stability in their revenues. However, the long-term impacts of weather patterns and climate change are not expected to be detrimental to Southern Company's earnings potential. And finally, construction risk and the company's ability to recover investments. Southern Company is required to make very substantial investments according to their capital investment plan in order to generate their earnings. However, this poses the threat of complications that can lead to disruptions in their cash flows and loss of investment capital. However, the imminent opening of the Vogtle Plant 4 greatly reduces their exposure to this risk, as this is their greatest liability currently from this standpoint.
And now let's get some historical context for Southern Company's financials. The first thing I want to look at is their earnings. You can see over the past 5 years that they've had strong net income growth of around 33.3% compounded annual growth rate. And the other thing I want to note about earnings is that 82% dividend payout ratio that returns significant value to shareholders. Looking at liquidity and solvency, compared to their industry peers, that current ratio of 0.66 is in line with those other companies, and that interest coverage ratio of 2.66 lets you know that even though they're highly leveraged, they're still able to meet those debt obligations. Looking at more of a peer analysis, something that really stands out about Southern Company is that higher EPS than its competitors, as well as that return on equity, where they're even, not only is their allowed ROE from regulators higher at over 10%, they're also able to actually capture it more successfully than some of those other competitors. And now let's see how they're able to generate some of those returns by looking at their capital investment plan.
Yeah, so to dive into this capital investment plan, which was a huge part of our pitch, right here you see a $43 billion plan that was presented to us by Southern Company through the end of 2027. We learned on their earnings call they're now elevating this to a $48 billion plan through the next 5 years. And in 2022, their capital expenditures represented almost 5% of the entire industry, which is allowing them to generate higher revenue, which we're going to talk about on this next slide with the revenue requirement model, which is how regulators control the amount of earnings for companies like this. And what they do is a company has to calculate their rate base, which is their cumulative investment in their infrastructure and their assets, which we have here for each subsidiary. And then you calculate how much of that was financed using equity, and then further multiply that by their allowed ROE set by regulators, and that gives you their maximum their maximum earnings requirements, which we then backed into revenue, which we use with DCF that Tracy's going to talk about.
Yeah, so for the DCF, we did use the revenue requirement model to back into our revenue growth assumptions and our revenue. By doing this, we had to project out our operating expenses for the next 5 years by 3 key factors. These 3 key factors included the decreasing natural gas price projections, the decreasing wage rate growth projections, as well as the oil price projections. By using a WACC of 5.47% and a perpetuity growth rate of 2.5%, we came out to an implied share price of $67.52.
The dividend discount model was also important for our valuation of Southern Company due to the historical strength of the company's dividends and their contribution to value for investors. We started off with an 8 to 9% annual increase in the company's dividend per share, in line with their historical annual increases in dividends, and that was followed by a perpetual 2.5% growth rate for their dividends, taking into account the maturity of the company relative to their business life cycle, and maintaining conservatism in our estimates for the perpetual growth of this company. This brought us to an implied share price of $75.56.
Yeah, looking a little bit more about the comparable companies and the relative valuation, we use the median PE multiple of their comparable companies because PE multiples are widely used in the industry because of those kind of highly predictable earnings because of the regulated nature. And that median multiple is 18.8 multiplied by the Southern Company EPS guidance for 2023, yielded a share price of $67.76.
So for our last valuation method, the Monte Carlo simulation, we used the geometric Brownian motion. By doing this, we analyzed the last year's historical daily returns and got an average natural log return and the standard deviation of the returns. And we also implemented a random variable with a mean of 0 and a standard deviation of 1 to implement shock to the simulation. By running the simulation 5,000 different times against this random variable and the returns, we came out to a mean price of $70.33, which then we did use for our implied share price.
And when putting all of those valuations together, the first thing we wanted to do was look at both relative and intrinsic metrics, which is why we have our relative valuation weighted the same as our DCF. And then most important in coming up with our actual valuation is the high weight on the dividend discount model, because Southern Company being a utilities company and our investment thesis being predicated on that strong historical dividend return and growth yields that is going to be where most of the value in that future share price comes from. Southern Company altogether comes out with our valuations to an implied share price of $70.74 with a total upside of 4.5%. Looking at that historical strength, the fact that they operate in a region that is not only growing in population but also energy usage, and their consistent ability to get close to their total allowed ROE above their competitors, as well as that strong capital investment plan demonstrated through Plant Vogtle 3 and the subsequent opening expected of Plant Vogtle 3 in April of this coming year, we expect that Southern Company is going to be a buy for shareholders. Thank you.
So you mentioned that high capex will lead to higher ROE. Can you expand on that?
Yeah, so that high capex doesn't necessarily lead to a higher ROE each year. That ROE is pretty stable in this industry as it's kind of set by regulators. However, with higher capex, they are gonna each year, based on that ROE, gonna have higher earnings. Which, if that CapEx plan continues to grow, which on their earnings call they do see, not only do they raise it to $48 billion, they have set aside another few billion that they think they could add to smaller infrastructure projects. So with that steady rise, those ROE level is going to stay similar, but those earnings are going to grow.
You mentioned that this company has lower volatility compared to peers. Did that refer to the stock price or something else?
That did refer to the stock price. So, for example, when we looked at their actual beta, it came out to around 0.5, which was below the industry average compared to other companies we looked at.
I see. And also, one more question is, it sounds like a data center is a potential big growth driver for the company. How big of the revenue will likely come from data center, just based on your understanding of this company?
I don't believe we have specific metrics factored into that, and it's not something that we added into our valuations and quantified. It's more so just looking at the long-term potential as a qualitative factor for us. We believe that the growth, both in artificial intelligence and the building of those data centers, is going to lead to more energy usage.
You had an ESG score on one of the slides. I was just wondering what the source of that ESG score was.
The ESG score of a source from Refinitiv. It's in 2022, as 2023 ones have not come out yet on Refinitiv. So they do see a pretty stable one. They have decreased the greenhouse gas emissions 49% for scope 1 emissions since 2007, and we project that to keep going. We are projecting that they will rise, especially with the planned Vogel units being carbon emission free. They partnered with the PGA Tour for the past 2 years for 100% renewable. They implemented like EV charging stations. They help with their natural gas emissions. So we do expect more partnerships throughout the United States and the Southeast specifically for these. So the ESG score will, we think, eventually be in the top 10 in the next coming years.
On one of the slides, you had FY22 numbers
Yes.
for the leverage and how that compares to the other comparable companies. So it seems like 2022 was sort of an exceptional year, given the rise in some of the utility prices. Were you able to track back as to what historically the leverage has been compared to the peers?
I think historically leverage has stayed pretty constant. The industry as a whole is pretty highly levered. We did kind of look at that as kind of a risk, kind of based on their leverage ratios, but also when we compared that historically and compared to competitors, it was pretty stable and pretty constant relatively.
One more question was regarding the simulation analysis in Monte Carlo. What variables did you guys simulate, and expected to have the most variability on the share price for that analysis?
So for this analysis, as they do operate in like a very stable industry, their returns are pretty stable, especially for daily returns. This is a 1-year price target using this method. So by doing this, we looked at the average natural log returns, and the biggest variable within the simulation was that random variable with a mean of 0 and a standard deviation of 1 to kind of implement and make it independent versus the past returns. So we have that variable running for all 252 days for the trading days of the year, and we ran that variable like by itself every single day to kind of add that randomness for everyday returns. So that's the uncertainty risk involved in this simulation.
I think you talked about climate. How do weather patterns or climate affect our earnings?
The short-term fluctuations in weather can impact their revenue generation because the majority of their operations are in the United States Southeast. Higher weather prices and the higher weather patterns and temperature in the summer can lead to higher revenue due to air conditioning necessity. However, fluctuations and short-term cooling events can limit their quarter-to-quarter earnings based on these weather patterns. However, looking at it from a long-term perspective, these short-term fluctuations are not expected to significantly reduce the long-term earnings potential of the company, and the impacts of climate change don't pose a threat to any long-term loss in profitability.
Yeah, and just going off that it causes fluctuation kind of their quarterly earnings, but on an annual perspective, we don't see a huge difference.
In terms of ESG, can you talk about how this company compare with their peers?
Yeah. So So looking at the ESG section and it being 13th, you see a lot of companies do have that net zero target by 2050. It's kind of standard across the industry, as well as reducing the greenhouse gas emissions. Our biggest thing for Southern Company was that partnering with the tour, partnering with different businesses, and getting their EV charging stations nationwide, and trying to implement to that space with the EV cars, kind of increasing in today's population and today's investors are looking at that. So relative to his peers, it is like relatively close, but we do see an increase in the next couple of years, especially with the initiative, the plant logo units being carbon emission free. That was kind of our biggest hit for ESG, because if they're doing that now, we can only expect them to get more and more in the future as the technology evolves, and like especially with the renewable energy sources.
How about on the social front? How about on the social front? You mentioned they have good diversity. What's the composition like for the leadership team?
I actually did not look into other diversity for different firms. I just looked at their diversity and being ranked in the top 50 itself. Our mall companies kind of really just stood out to me. So relative to their peers, I do expect them to be a top in diversity just based off that statistic. They also do have partnerships with HBCUs, as I said, for campus recruiting, and they are giving out grants to also encourage that recruiting. To kind of go along with that, outside of diversity with military installment programs, they are looking to recruit veterans that are looking to get into the workforce after they get out of the military. So just that, and then connecting with diverse suppliers, they've seen an increase not only within their workplace, but increasing with their suppliers for their operations by connecting with diverse run businesses and things of that nature.
So you use different valuation methodologies, and most of them actually, your target price with most of them was lower than your summary target price. And what I noticed, their dividend discount model actually yielded the highest valuation number. Can you talk about if you see dividend as sustainable going forward, and why you thought that it was appropriate model for this company?
Absolutely. So again, our dividend discount model is the heaviest weight within our valuation methodology. And this is pretty much the reason why. When you look historically at Southern Company's share price, 70% of the value is coming from that dividend growth. And a few reasons why we see that continuing into the future. Not only historically have they been successful, but then one, staying committed to it from a management perspective and having that be one of their primary goals is actually making sure that they can continue to increase that dividend and provide that value back to shareholders. One, again, the geography where they're operating, their continued expansion plans of including Plant Vogel, and just expanding energy production as well. We believe that the combination of those historical factors as well as their just future outlook, they will be able to sustain that dividend growth. And again, it is primarily their primary driver for shareholder value.
And kind of to bank off of that, with Plant Vogel finally being done in quarter 2 of 2024, we do expect those cash like inflows to that project to come out, so that way they can have more cash to get back to their shareholders. So that's also a primary reason we do see the dividends to continue to increase, because they will have more cash for their shareholders in dividends.
And what is your long-term dividend growth rate assumption?
The long-term assumption takes into account that Southern Company is at a very mature point in their business life cycle. So the perpetual growth possibility is a little more minimized than some other companies that are a little bit younger and have a little bit more growth potential. And in addition, we wanted to maintain conservatism in our estimates, so we didn't want to assume an overly aggressive rate. If you look at their percent increases in their dividends, they typically increase it by a fixed amount on a yearly basis by dollar amount. And once that percent as a percentage of their total dividends goes close to or around 3%, they then increase the dollar amount that they're increasing their dividends by annually. And we think that although it's typically around 3%, that 2.5% was an even more conservative estimate of their long-term growth potential.
Do we know, is the company forecasted to be cash flow positive in the next, at any point in the future? Or are they always going to be negative free cash flow?
A lot of that kind of depends on kind of how the operating expenses pan out. Our projections indicate they are going to be cash flow positive, and historical kind of varies. Sometimes they're cash flow negative, sometimes they're positive. we are projecting that they'll be cash flow positive. in the future.
When will
We are at time.